Welcome to the Wealth Insight podcast. I'm Vinay Joseph, your host. My guest today started out in distribution at ICICI Prudential AMC, then took the top job at Motilal Oswal AMC in 2013, growing it from around 1,300 crores to nearly 43,000 crores by the time he left. Today, he leads the domestic business of WhiteOak Capital. WhiteOak holds licenses across mutual funds, PMS and AIF and manages close to $9 billion in Indian equity. He's a self-described detailed person, and his view is, in a probabilistic game like ours, you can't control the outcome. What you can control is the quality and consistency of what you put in. Aashish Sommaiyaa, welcome to the show.
Thank you for having me.
You've said in your earlier interviews with a straight face that you're paid to meet people and make friends. 25 years, you're still holding to that view?
Yeah, of course. I mean, see, I've always been with the mutual fund industry, right, since late 90s. And when you're managing mutual funds, you know that these are like a perpetual train, right? I mean, there's no start point or end point, correct? So which means that you're consistently dealing with the same set of people, and sometimes they know your track record as well as you know. And so, for so many years, if you end up dealing with the same people and talking about the same things, keeping them updated about your progress, obviously eventually you end up making a lot of friends. So I think I'm in a great place.
So one part I wanted to talk was more of your journey also in product innovation.
Yeah.
In your earlier firm, you had helped set up the entire passive business, especially international passive investing option. And in case of WhiteOak, we have seen how the evolution of multi-asset investing.
Yeah.
So what has driven that product innovation in your strategy?
What happened was that for the first time, actually, I was involved in creating a global investing product was actually when I was in ICICI in 2010, right? And then, like you said, at that time, I was involved with my then team to create a US equity fund. Then when I was at Motilal Oswal, we created NASDAQ and S&P 500 and a plethora of products. Now, if you really ask me, why did we create international investing and passive? The reason is because, when it comes to investing in India, of course, we were capable. I mean, we had an on-ground research team. But we felt that Indian investors were always overexposed to India. And this today it has become very popular, but I'm talking to you in the range of 15, 17 years back, when we felt that Indians are investing into equity in the domestic market, but there are many opportunities which are outside our shores, right? This whole, what you're now calling hyperscalers, right? All of those are not listed in India. Commodity companies not listed in India, right? Other than India, there are very big domestic markets like China, Latin America, etc. So we realized that a lot of people have practically no exposure to investing globally. Second is that we created passive because we couldn't have claimed to have expertise of selecting stocks in another jurisdiction. Yeah. And third thing is that we created them as also index funds instead of ETFs, if you may notice, is because in India now a lot of people are buying products on fintech platforms, and there's a lot of this DIY kind of thing also playing out. So the hypothesis is very simple, that if you can buy, by putting 500 rupees a month, if you can buy NASDAQ and S&P, then what better can you get? Coming on to this whole multi-asset thing, if you really see, I personally by nature I am a bit contrarian, so I like to look at where nobody is looking.
Yeah.
Correct. That's why in 2023 we wanted to create a product which allows people, and see, I have seen that there is a lot of winner rotation, a lot of volatility. So we wanted a fund which will give you fixed income plus return, but with as less volatility as possible. And that is why we created a true blue multi-asset, like with some 25-30% in gold and silver, 25-30% equity, REITs and InvITs, fixed income, all of that. So each of these things is born out from the fact that we end up meeting a lot of smart people, we take their feedback, plus we have our own observations and hypothesis of what is relevant in a particular market context.
So building on that, in the current market context, what do you think in the mutual fund space we are missing and we should be ideating or solutioning?
As you asked the question, I was thinking, but I think the key lies in the last words you use, which is solutioning.
Yeah.
Right? And I know that you run a very large wealth management practice and you have responsibility of allocating client assets. I personally feel that what is happening is mutual fund investing itself, it's simple but not easy, right? Because practicing right asset allocation, like see, I know that you put out a very good report, but then people need to follow
that.
what you put out in the asset allocation. You also do manager selection and fund recommendation. I think that also people need to follow. So what I feel as we go along, what will happen is that over a period of time, I think solutions which are something in the nature of fund of funds, right? So let us say you already have a view on what asset allocation should be made for what client profile, and you already have done your work of where those assets should be allocated across fund managers and types of schemes, right? So if you are given a product or a wrapper where your advice gets embedded in the wrapper, so a mutual fund is a product.
Yeah.
But if I give you a bouquet which is as per your requirement and it rebalances, makes changes to asset allocation, makes changes to manager selection, and your advice in a high fidelity manner gets implemented through that product. So I think solutions is going to become big.
So Ashish, I wanted to take the discussion further to क्या market कैसा लग रहा है, outlook on that. So we are operating in a very volatile environment and an uncertain environment. Market cycles are getting compressed. We are seeing rising geopolitical tensions. So across asset class, in your view, where are the opportunities right now?
Yeah, see, I think related to what you mentioned, Vinay, what is interesting is that now, the narrative is becoming kind of, extreme, right? I mean, in recent times.
Yeah.
So if I can just tell you on a lighter note, when in 2024, when the market was making new highs, then, all the discourse was about Atmanirbhar Bharat and Amrit Kal, correct? Yeah. Now, 2 years down the line, index is more than 10% lower than where it was. Yeah. Correct, and people haven't made much return in the last couple of years. So now the entire discourse is that, come on, I mean, you guys don't have AI, you guys are even importing oil, you have energy issues, you're importing so much gold, rupees depreciating, FIs are selling, it's almost sounding like a basket case, correct? So that is the spectrum to the extent which the narrative has really changed. It almost feels like you're talking about two completely different countries, correct? If you really ask me, whereas if you stick to the numbers, while I know that there is a war in West Asia and oil prices, current account deficit, all these are areas of concern. But let's understand that in last 25, 27 years, I've seen this playing out exactly 5 times. When we had energy prices going up, we had currency depreciation, we had FI selling, we had geopolitical issues, and related to that, some sort of economic vagaries, right? The entire period from 98 to 2002 was like that. 2008-9 was like that. 2013, then come to 2018, 19, 20, as recently as 2022, and yet again, correct? So if you ask anybody that should you have invested in 2001, yes. Should you have invested in 2008, yes. Should you have invested in 2013, sure, why not? Should you have invested in 2019, 20, yes. Should you have invested in 2022, yes. So should you invest in 2026, no. Right? That's why some wise man said that all past crises feel like missed opportunities. Only the current one feels like a threat. Right? So I think investing in the market is as much about the math and the economics as it is about the behavioral and the psychological aspects. So my sense is that currently it's true that we are going through some macro headwinds, but I think a lot of it is in the price, number one. Number two, eventually at some point in time, part of the macro headwinds will also get addressed because you are seeing that all the right questions are being asked as far as this whole AI run-up is concerned. All the right questions are being asked. Like say, for example, US, when you are following for so long, how many times do you see US economy in a spot where the economic growth is slowing down, unemployment is rising, yet inflation is rising, and they cannot cut interest rates, right? And there are not enough buyers for their bonds, correct? So what is going to happen is that eventually FI flow, dollar, all of this is relative to something. And I think that something is set up for a big correction. So on a relative basis, I feel that these macro headwinds will pass. And eventually all the crises have always turned out to be good opportunities to start investing. It's just that people find it very difficult to invest when the recent past doesn't look good. But that is the psychological hurdle that one needs to overcome.
Right now, as WhiteOak, you all are leading advisors to a lot of foreign investors. Actually, people don't realize you all manage $9 billion of money flowing into India through your foreign channels. So given the outflows which we have seen over the last
Yes.
18 months, what are foreign investors thinking when they come to you? Are they still structurally positive on India, or
Yeah.
is it more of just a cyclical rotation which is happening?
From 2020 till say mid 2024, there was consistently good interest and good allocation coming into India dedicated funds. So what I've seen in the first 4 years that I spent here is that India as an asset class, it was actually becoming a single country asset class on its own. You were seeing a lot of interest in India, and India rewarded people very, very well, right? After 2024, of course, our economic growth suffered, and more importantly, just when we were going through a soft patch in fundamentals, there is a big AI rally which happened outside. So, in the last 1.5 years, I have seen that there is some, some outflow from India strategies, but emerging markets, we've gone literally from practically from $0 to $3 billion in the last 4 years. And those emerging market strategies also do have some allocation to India. So all in all, what you will find is that in the long range, India has started to evolve as a single country asset class, right? There has been more and more interest coming into India. Last 1 to 1.5 years, there has been a reallocation away from India into other competing markets. But I don't think that we should extrapolate that too much into the future or read too much into it, because if you take say 2010 to 2026, for the most part you will see, in 16 calendar years, 11 times India has big positive net flows. Twice it is close to zero, 3 times it is negative. This is probably the 4th time that it is, 2026 is the 4th time where it is going negative. But if you compare all of this to other emerging markets, what you will find is that they are more negative than us. They have underperformed compared to us, barring the last 1 year. And there are more instances and larger volume of negative. Right? So India has, till last year, has always been a relative rank outperformer, attracted more flows. Only last 1 year has been a soft patch. And like I said, these are things which are macro headwinds. I think they are, in the passing.
Every episode we end with a particular section, and in this particular edition, we have started a section called Beyond the Portfolio, and it's a conversation we take away from markets and discuss about your different passion points. And one thing which we have learned, and I've read a lot about you, you're a very avid reader, right? You voraciously consume a lot of content as well as you read that. Could you describe why are you so passionate about being such a voracious reader?
See, I think, 2-3 things that I've seen. One is that, it's like, I read it somewhere long back that just like, when you have, when you use computers, when you use all these digital gadgets, every once in a while, the operating system has a refresh or a upgrade, that's how the software gets upgraded. So I think if you use your brain as a hardware, then all the reading is all your system updates and the software updates, right? So I think that, and a lot of original thinking comes up in the books that I've seen.
So before we go, if for the viewers, what are you right now reading, and if there's any recommendations you would like to give?
So, just this morning I was listening to Howard Marks. And I think this is a good time to revisit that Mastering the Market Cycle. Okay, because I was hearing him on a podcast, and I'm very influenced by what he has written. So I was thinking that I should reread that book. But apart from that, I think the book I found very interesting. I read it just finished few days back. Is a book on. It's a book called Plunder. Right. It's a book on the evolution of private equity and what type of effects private equity has had on US economy and US markets. So that is the last one which I finished. It's very interesting. And then apart from revisiting this book on market cycles, I'm also reading Mr. Lloyd Blankfein's biography, Streetwise. That is also very interesting. Then at some point I started reading 1929, which is about the Great Depression. Intuitively a few things about how it played out because you've read up about it. But in the book, in that 1929 book, I think getting to know the characters is the more interesting part.
Yeah. No, some great recommendations, Aashish. Thank you for sharing. That's all for this episode. From the business he built to the books he treasures, we have seen the thinking behind the person, patience, consistency, and the long view. But we are far from over. We will take this discussion forward in our next episode of the Wealth Insights podcast. Stay tuned.